For more on the markets and expectations for third quarter earnings, we want to bring in Cameron Dawson. She is Chief Investment Officer of New Edge Wealth. And Cameron, what do you think of the reports we've already heard this morning? It sounds like just about every one of the companies, if not all of them, have beat expectations this morning. But if you listen to the commentary, there are some signs of concern about what comes next for the economy.
I think that is exactly it. There's a lot of blocking and tackling this quarter. You see by a name like JP Morgan still able to do an 18% return on equity, just shows you that even in a challenging time, they're still able to be very profitable. But then the question is, do times get even more challenging? JP Morgan talked about how consumers are starting to spend down their cash balances, that they're not at a point of reaching the full exhaustion of their spending capability. But of course, banks are very aware that if consumers continue to get pinched by inflation, things like higher oil prices, you've spent down the cash balances, how many more levers can you pull for the consumer to be the sole driver kind of upside surprise for this economy, which is the big question going into 2024.
So where do you come down on all of this, Cameron? We had seen this kind of pressure on stocks that brought things down, real negative sentiment, but that's kind of reversed over the last 5, 6, 7 sessions where people are thinking maybe the sell-off was too much. What camp are you in?
Yeah, we thought that some sell-off was very likely given the seasonals, but we're starting to see this pressure when we've returned down to the 4,200 level in support of the 200-day and rallied back up to that 50-day moving average, kind of losing steam, which just means that we're likely in for some more sideways chop. When we think about the messages the market is sending us, one of the most important things that we're watching is how consumer discretionary stocks are performing versus consumer staples. That actually is a really good indicator about forward growth expectations for this market. And I think one of the most interesting things is that ratio has held up surprisingly well throughout all of this correction, which brings us back to a point that maybe this correction really hasn't been about growth fears. It's been about interest rates and valuations, some kind of digestion of that, instead of this rising fear of an impending recession.
All right. Well, if it's about higher interest rates, get ready for some more indigestion potentially. You're right. We've seen stock prices come up as the yields on interest rates came down over this last week. Jamie Dimon, though, says he would not be surprised to see interest rates higher from here, just given everything that's going on around the globe. If you look at potential for the strong job market that we're seeing right here in the United States, and then what to anticipate from the continuing war in Ukraine and the attacks on Israel this week, that all of that could add in to additional inflation, meaning that the Fed may have to raise rates.
Yeah, and he also called out those record peacetime deficits, which is really important because we're seeing this big increase in supply of treasuries that's not being taken down very well. That's what we saw yesterday with the treasury auction going rather poorly for the 30-year. And I think the interesting thing here is that if you even look at the Congressional Budget Office projections for 2024, they have a little bit of an improvement in debt to GDP, but it really isn't that much of improvement. Still about 6%, which is very elevated given the fact that we're still in a strong GDP environment. So what happens if we do enter a recession, GDP falls, and you have to spend more for more countercyclical measures? Where do those deficits go? What does that mean for Treasury supply? And then what does that mean for Treasury yields, which could still be biased higher?
So, Cameron, what do you like when you look around? I mean, that's a lot on either side of the ledger for the bulls or the bears. What do you come out thinking?
Yeah, we've been liking this pair in the sector standpoint between technology, which still has very strong trends. You don't want to fight it. We still have very strong earnings growth within technology within 2023 and even looking in 24. And then pairing it with something that's a bit more value, cyclical value like energy. Energy has the worst earnings growth in 23, which does set you up for some pretty easy year-over-year comparisons. But if we start to see oil prices continue to rise as they are this morning, relying on geopolitical risks, that's an area where if the rest of the market does not like those oil surprises simply because it would exacerbate inflation, energy would do well. Energy is a very cheap sector as well. You've also seen a lot of outflows from that sector. So we like the highest quality names within the sector, names that generate a lot of free cash flow, don't have too much debt, but we think it's a sector that was left for dead in 23, which could set it up for a much stronger 24.